All right, and we should be live here. Hi, folks. Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart here. We're doing this special report. This is in response to the latest Fed policy announcement. We're continuing our relatively recent schedule of bringing Axel Merk on same day as we hear from get the Fed news and hear from Jerome Powell's press conference to do a live reaction video to it and then take your questions live here. If you're watching this live, that means you're one of the premium subscribers to my Substack. So thank you. Welcome everybody for joining. Axel, thank you for joining us. How are you doing today?
Oh, it's been a roller coaster, and not just because of the Fed, but I'm doing well otherwise.
Okay, good. Well, look, we'll just jump right into it, folks. I've got a couple of prepared comments here, just to get things rolling with Axel, and then I'll start taking your questions. Ask your questions here in the live chat. I will start pulling them. Again, just a reminder to my good guest, I didn't give him the proper introduction, but Axel is the president and chief investment officer of Merk Investments. I often call him a Fed watcher. I know that Axel wants me to remind folks that he's really more of a portfolio manager, but he feels he has to watch the Fed because the Fed is the bully on the block with the bazooka. And whether you
somebody is listening.
And whether you agree with that bully or not, the fact that he's got a bazooka just means you got to pay attention to what he's doing with it. The Fed announced today that it is keeping its policy interest rate steady at 5.25%. And that it plans to reduce the pace, or really the size of quantitative tightening. So starting in June, they will let a smaller amount of U.S. Treasuries roll off the balance sheet. They were doing $60 billion a month. That's going to decrease to $25 billion a month. And they're going to maintain their monthly retention cap of $35 billion for agency debt and for mortgage-backed securities. So Axel, we'll get into all this in just a second. But folks, again, as a reminder, I'll get a few questions out here for Axel, and then I'm going to start pulling your questions. So make sure you ask them in that live chat. All right. So Axel, I kind of took away from the Fed's policy statement, but really more from Powell's press conference. Was sort of like, hey, we got caught by surprise by how stubborn inflation's remaining. We probably shouldn't have guided everybody to rate cuts the way that we did. You know, I think Powell's kind of saying like, I'm going to be a little cagier going forward here, and just tell everybody that I'm just going to make decisions based on the data as I best see fit. He did say something several times where he said it will take longer to tame inflation than we previously expected. So it was an admission from the Fed that, not only were they a little too optimistic, but they think that it is going to be stubborn to get inflation down to their 2% target. They have reiterated they're still shooting for 2%. So even though a lot of people expect them to eventually walk that up, Powell's not admitting to that yet. And he also said, we don't want to be early in cutting, right? So he keeps repeating this like, okay, we're going to do whatever it takes. If we're going to err, we're going to err on the side of staying a little too high versus a little too low in terms of our interest rates. So love to hear if you took the same takeaways I did, but importantly in your answer, if you can address this question: did Powell err back in December when he came out with that surprisingly dovish guidance and got the market all excited about 3 to 7 rate cuts in 2024?
Well, there are two separate discussions, and since we have a few hours, we can get into both of them.
Okay, all the time you want, my friend.
Let me first provide some important nuances to what you said. You made it appear almost as if Powell were suddenly shifting to look at the data and be open to anything. That is not what he said. He said he is not going to cut yet. He did all but rule out that he would now have a tightening bias. He does believe policy is tight. And the only thing he said that he is not cutting yet. And so I think that's a very important difference, because the market was starting to think, some people were starting to say, hey, maybe they should hike rates. And he emphasized that point by referencing the JOLTS report. For those of you who have been following the Fed, ever since Janet Yellen, the market has been focusing on the JOLTS reports. That's the job opening and loss report. And the job openings have been coming down. And so that is a sign that the economy is weakening. And Powell's takeaway is the economy is weakening, which means the current level is restrictive. And so he just has to wait. The other thing he said, he kind of untangled some Fed speak. He said 1 or 2 months don't make a trend, but 3 data points are a full quarter. So Fed speak translated to English is that if inflation doesn't come down in a full quarter, it's not coming down, and the Fed will have to be more patient. So the short of it is that the Fed will be sitting tight here. The Fed will be waiting, and if the inflation comes in a little hot, they presumably not going to do anything. If the Fed comes in a little bit, the inflation comes in a little bit lighter, then they will look for an excuse to ease, and that's part of the reason why the dollar weakened, why gold went up, and at least initially the equity markets went up. They closed down. Now, to address the other question, whether Powell was wrong with the sort of guidance he gave. Powell is wrong in giving guidance, period. It's just a no-win situation to give this sort of guidance. It's just that in the last, whatever it is, 16 years or whatever it is by now, the Fed has gotten used to giving guidance left and right. But what's the value added? And I mean, I've ranted on this before. It used to be that the Fed was able to look at the yield curve, get an assessment of the market, and act on that. The Fed took that away when they started giving more explicit forward guidance, and now has to read the tea leaves of the same reports everybody else is doing. And so they have to act with a lag on a policy tool that acts with a lag. Giving forward guidance on that tool just makes no sense whatsoever, and is going to come back to bite him periodically. And this is one of these moments where he got bitten. Now, that said, does he really care? I mean, he controls the bazooka, as you mentioned, right? And so the market is gradually pricing out these rate cuts, and that's where we are. And he's just acknowledged it. So there's really a lot of talk for pretty much just saying he keeps his easing bias, which is somewhat friendly, at least to the precious metals market. And other than that, he doesn't really know what's going to happen, and so we should sit tight.
So you were right in that, especially during the Q&A, a lot of folks were trying to really pepper him with questions about cuts in 2024 or potential for a rate hike or whatever. And he was kind of, bobbing and weaving and bobbing and weaving. But he did say that it is quite unlikely that the next move would be a hike. He seemed to sort of say, like, barring some new surprise coming into the mix, when it does act, the Fed is likely to cut. It's just a matter of how long it's going to be.
Now, why does he have this press conference? I mean, isn't that kind of obvious, right? I mean, so we can talk about it. I mean, it's kind of nice, but what about just letting the data speak and the Fed doesn't have any press conferences? What would be lost if he hadn't said anything? Right? There has been this drive for transparency, but this transparency has led to coercion of the market, inducing volatility. There's just no value added, I don't think, in this sort of communication.
Well, assuming he could get away with it, have we had a Fed chair that just didn't give press conferences?
Yes, it used to be the case. We didn't used to have press conferences. Greenspan didn't give press conferences.
He didn't. I remember he was famous for.
His briefcase indicator was his press conference. Depending on what was stuffed into his briefcase, people kind of gathered as he's going to hike or lower rates. He testified. No, press conferences were rare.
Okay, because
this thing about press conferences is a result of the financial crisis, that they increasingly need to communicate. It used to be the case that the Fed would move rates and not even announce that they changed rates. That used to be the case, and the market, based on what's happened in the market, they would realize that the Federal Reserve had changed the Fed target, and so all this has been gradually progressing. That didn't used to be an inflation target, right? And so the market was somewhat guessing that it's 2%, and now we are obsessed with, the Fed is obsessed with 2% to the X decimal point. Volcker used to be a critic of that. There are lots of people that think that's good to articulate it. I don't think it's very helpful.
So would we be better off, do you think, if we return to that type of environment?
Yes. Get rid of all the complexity. I mean, you talked about the complexity of the balance sheet reduction. what the hell is that all about? I mean, I'm not criticizing you, but if we didn't have to deal with any of this, right? The Federal Reserve used to have an open markets desk in which they intervened in the markets to manage the short term the federal funds target rates. Now they pay interest on the reserves, and it's quote unquote easier, except when there isn't enough liquidity in the system and the system blows up, in which case they add liquidity again. Whereas the old system, the big advantage of the old system was that the Federal Reserve would see when there were cracks in the system. Because if market participants wouldn't be able to kind of respond properly, you see where the vulnerabilities are. Whereas when you pay interest on reserves, um, it just works, and you don't know where the weaknesses are in the system. So there are lots of, it's more work for the Fed, of course, to do it, but there are lots of valuable tools that have been taken away. And a central bank, my goodness, they can have a press conference when they have something to say, but when there isn't anything important to say, the risk is that the Fed boxes itself into a corner, as happened now, right? And now for months the market is scrambling to come to terms with it. Now ultimately you can say it doesn't matter, the market it does what it does, but it does matter because the Fed controls the bazooka. They have an anchoring impact on the risk-free rate, and the talk creates volatility, and volatility is an expense. So all of that creates a less efficient market, creates less efficient economic growth, and ultimately erodes credibility at the Fed, because the more often the Fed has their foot in the mouth, the less trust there is in the Fed, and there's a real cost that comes with that. So, in my view, yes, they should get rid of the press conferences. Only have one if and when there's something really important to communicate.
Okay, but that may be the system we'd want. It's not the system we have, so we got to deal with what's going on here. Powell kept talking about how the labor market is still strong, but I think more than I've heard him give nod to in previous conferences, he did kept talking about how it is moderating, or as he would like to say, coming into better balance, right? But as you mentioned, we've definitely been seeing some. I mean, one, there's been dispute for a long time about sort of how believable some of the BLS reports are, but quite recently, even this morning, we saw data that's showing that quits have normalized, right? So they're now down to pre-pandemic levels. So the Great Resignation is sort of officially over at this point in time. But new hires are now down to a level not seen, I don't think, since like 2018 or something like that. So the trajectory there, sort of signifies the fact that the labor market is beginning to tighten up. Powell has said, "Hey, we've been super focused on inflation because we really haven't had to worry about jobs, and we've got this dual mandate. But basically, our strategy is whichever one is further out of whack from where we want it to be, that's where we put the emphasis." So he said, we're now finally beginning to give kind of more attention to jobs because inflation is moderating, and we're going to start looking at jobs. And he said that when asked about rate cuts, he said, well, there's really two things that are going to influence us to do rate cuts. One is that we get confidence that inflation is indeed going to hit 2% on some predictable path, but we're not there yet, or real weakness in the jobs market. And someone even asked him, like, well, how much weakness? And he said, well, I mean, I'm not going to freak out about a couple of tenths of a percentage, but if we start seeing really big concerns, yeah, we'll come in and intervene. And I'm wondering if a little bit of this is just sort of him setting a preview. In other words, do you think he's maybe more worried about the jobs market than he let on here? I'll leave it at that.
Well, he's always focused on the jobs market quite extensively. And they are just, since we talked about history a little bit, it used to be that the Fed's mandate was not to worry about the jobs market, but to worry about inflation. And for a very good reason, because if inflation is under control, that's the best thing you can do for the jobs market. Indeed, when Powell was asked about kind of the man on the street, he said, well, the tool that they have is to provide an environment for job growth. The problem with focusing on jobs is because you have a strong bias to keep rates too low. It's part of the problem that got us into the trouble in the first place in this latest round here of inflation. And so has he shifted? Well, he can talk more about it, that's for sure, because the market is weakening. It doesn't change the fact that inflation, of course, has its own dynamics. Once inflation is high, it doesn't come down linearly as he's experiencing now. And so he's looking for an excuse to lower rates. The market hasn't given him this excuse. And because the market hasn't given him this excuse, the rates stay where they are. But all this talk about the jobs market is in some way a sideshow. But what it all does, and I think that's partly what the market is reacting to, the market thought, oh, he's going to pivot from the pivot or whatever it is. He didn't. And so he is just showing his cards that he has an easing bias. And in that sense, nothing has changed. The data don't allow him to ease. And who knows? Well, we don't know what the future data are going to be, but that easing bias has not changed. And I think that's really the takeaway from this meeting.
Okay, so now we get to my favorite question, which is the lag effect. Powell was asked several times, do you think that your policy rate is sufficiently restrictive? He reinforced many times, yes, we believe it is sufficiently restrictive, and given enough time, it will bring inflation down, right? He also talked in a lot of other subcategories about the lag effect. A particular example he spent a lot of time on was explaining how shelter costs impact CPI and that they act with a lag. And he talked about the specifics of how, rents only come up once a year usually. And so it just takes a while, right? So my question for you, Axel, is, the Fed, a lot of people like to give them the credibility of a surgeon, but they really have more they're really more like a lumberjack with a chainsaw, right? It's just not, they're just not that precise, right? And what they can do. And
you can do some pretty cool artwork with a chainsaw if you know
I've seen it, yes, but it's not, fine calligraphy. My question is the longer that we hang out higher at these rates, and the Fed is waiting for the gravity of the rates to impact the economy, are we setting ourselves up for a more prolonged lag effect? So in other words, yeah, maybe the Fed's rate is sufficiently restrictive. We have to hang out here for another couple of quarters. But by the time things start moving, there is so much downward momentum from how long things have been here that things maybe go a lot lower. The economy slows a lot more than the Fed wants, that slowdown is more protracted and more prolonged.
Not necessarily, but let me first mention, I think it was about a year ago that I talked to you and I said the low point in the economy may well come just before the election. Now, I think I still stand by that. What I did say, though, at the time is that the downturn will be significantly more severe than I'm currently expecting. And so there I may have been a little bit too pessimistic. That said, of course, the question is, why is the economy holding up better? Is it because it's the most forecast recession ever, so it didn't happen because companies prepared for it? Is it because of the fiscal stimulus? I happen to think that's a very significant portion. Is it because some of the potential tail scenarios have been taken out of the market? I'm talking about the support given to the small banks. I think that's a big contributing factor. Is it the consumer that's locked into low interest rates? I think that is a factor. But net, of course, yes, the driving force is towards a weaker economy. I mentioned to you before, I bet on the consumer, and the consumer is weakening. Now, will it be more severe, the downturn? It kind of depends, right? If the fiscal stimulus abates, then yes, we can fall off more sharply and the lag effect is going to come in. But to the extent that all these other buffers will continue to be around, it remains to be seen. I think we'll see more distortions. We talked about Greenspan earlier. Well, Bernanke, in the book that he published towards the end of the pandemic, he talked about his vision for the future of central banking. And the way I translated that is that his nirvana is a command economy where every possible scenario is being micromanaged that could possibly happen. Now, Anybody who has studied command economies knows it doesn't work. But if you throw enough money at it, interesting dynamics might unfold. And so we obviously do this quote unquote command economy by propping up the regional banks. And so there will be all kinds of distortions. And so I'm a little reluctant to say, hey, there's going to be recession and therefore it has to be harder, because you always have to take into account the counter move that the central bank will do. By the way, one key scenario that we rarely ever consider is the scenario that the unknown hits us, right? The unknown is the difficult portion that can really get things out of whack. That's usually what causes a recession. There was a risk that an escalation in the Middle East would be that. We don't know what that will be. In that sort of scenario, yes, the Fed will cut and will cut sharply, and whatever that might be, it might cause a more severe downturn. That risk is always there. Historically speaking, central banks cut more than is priced into the market. And the reason is usually because some unknown hits us or something else happens, right?
Yeah. All right. And folks, just a couple more questions here for Axel, and then I'm going to get to your questions. History shows, and I've put up the chart many times, of when you see past rate hike regimes and pretty much every recession we've gone into, and folks, I'm not saying we're definitely going into a recession, but history shows that what tends to happen is the Fed aggressively hikes rates, it hangs out at a plateau, and then it scrambles to cut rates as recession arrives. And if you look at the current chart, we've had the aggressive hiking of rates. In fact, the most aggressive regime. We're now at the plateau. Do you expect it to be different this time, Axel, or do you think it's more likely history will repeat?
Your good is as good as mine, right? I mean, it's the thing about procrastinating about how things will play out. The only thing we know is that most of these forecasts are wrong. And so I'd love to give you with great certainty something, because at least then you could bet that whatever I say is going to be wrong. There's the thing that should play out. The thing that should play out is that this consumer is gradually weakening, that the Federal Reserve will react to that, will ease, and because we're at reasonable high levels, we may go back up. That said, right, look at commercial real estate. They haven't cleaned up their act. Look at the banking system. They haven't done their thing. And I have compared the issues in the small banks to what happened to the savings and loan crisis in the 1980s. It took almost a decade to clean that stuff up. It's because the political will is just not there to take care of these things. And by the way, we have an election coming up later this year, and there may be some changes, right? I mean, one party talks about rate hikes. Who knows what's going to happen? Rate hikes on the tax rate side, right? And so all of that may have a greater impact than whatever we might be musing about here.
Okay. Speaking about the election too, Powell, it sort of came up in the Q&A, and Powell went way out of his way to say, hey, we don't play that game. Like, it doesn't even factor into our thinking. Look at our transcripts. We don't even ever talk about it. Curious to get your thoughts on that. I know, again, that you've interacted throughout your career with a lot of sitting Fed executives or former Fed executives. And just to preface this, I don't know if you got a chance to watch did you get a chance to watch the interview I did with Thomas Honig?
Absolutely.
Okay. He said there, when I asked him the question, he said, I mean, the two voices that speak loudest in the FOMC's ears are Capitol Hill and Wall Street. He didn't say specifically that the Fed's not independent and it's not influenced by these guys, but he certainly gave me the impression that those guys have a voice at the table. So,
well, they're human beings, right?
How sincere was Powell's answer?
Yeah, I mean, first of all, Powell stuck to the talking points, right? He must not say that they're influenced by politics, and because there's nothing good that come from it. Now, my reaction is, well, if they shouldn't say anything, they should also stay out of fiscal policy. And a lot of the policies since the financial crisis that the Fed has adopted are in fiscal territory, starting with buying mortgage-backed securities, right? A central bank is not supposed to allocate credit to a specific sector of the economy. Now, many people accept it, but of course, there have been business loans during the pandemic, right? All of that is political. And so the Fed has become a political beast. And if they don't want to get the political backlash, then they should get out of that territory. Now, that said, part of the reaction was, of course, the Wall Street Journal had a longer article about how some people close to Trump are suggesting to reduce the independence of the Fed. And so he needs to stay very clear of any of those discussions. And in my view, by the way, politicians must stay out of that realm because, again, it makes Fed policy more expensive. Fed policy gets diluted if it gets more interference from the political side, and you need to do more to achieve the same thing. And obviously, central banks that have had a lot of influence from politicians have seen high inflation, right? Because the political drive is to favor low unemployment over anything else. Now, does that mean that the Fed should remain untouched? I don't think so. I think the Fed should lose its discretionary power and should move to a rules-based system. Further taking away, by the way, the political influence to let it be more on autopilot, because the value added with the human factor is negative. We see that through the Great Depression, great inflation in the 70s, the great inflation we had now. The cognitive biases of a committee will get them to make bad choices.
Okay. I think I've asked you this before, and just give me your quick answer. We can expound on it later. But do you think the Fed should drop its low unemployment mandate? Should it just have a single price discovery mandate? Or
Well,
price
it's the
stability
law,
mandate?
right? So they have to, the central bank has to do what the law says. And that's why
Right,
they
but that
have
law
to,
has been
they have
mission
to.
creep over time. They added it later. So
They Mission Creek, and also even as that was in there, central banks have usually said we stick to the inflation mandate, and that will take care of the unemployment mandate. In my view, that was the right way of looking at it, right? By you provide an environment for maximum employment by keeping inflation low. That is the correct approach, right? That said, right, you asked me earlier, hey, what's Powell's focus? And he has an inherent bias. He's always had that bias. That he prefers to have low unemployment. Now, obviously, it doesn't mean he can't raise rates. He has shown that he can do that. But in a day like today, he clearly signaled that his foot is on easing, and the market's obliged.
okay. Two last questions, and then we'll go. And I'm not even going to ask about gold because I'm assuming folks are going to ask about it. By the way, folks, we've got 3 questions: 2 from Neil, 1 from Greg. Feel free to add some more while I'm asking Axel these last 2. These are more sort of international. I'll ask them both, and then you can address them. I had an interview I recorded and still haven't had a chance to launch on the site yet with Simon White, the Bloomberg analyst, and he's been looking at China. And China has been in a consumer recession and has not stimulated to date as much as a lot of the Western nations did. It now has announced stimulus and a big jobs creation program there. And Simon's take was that consumer recession in China, he thinks, was sort of the knock-on effects of that were responsible for about 70% of the disinflation that we saw here in the West, like in the US, from going from 9% CPI down to 3.5 or whatever. He thinks about 70% of that he attributes to that consumer recession in China. So he thinks that if China does go into stimulus mode, that is going to flip China from being a net drag to a net booster of both the economy, but it's inflationary. And therefore, that might make it even harder for the Fed to get this stubborn inflation down further. One, do you have any opinions on that? And then the second one is, can you just explain for folks what implications the Fed's decision to keep rates higher here is going to have for the Japanese yen and why that's important?
All right, I'll give you a few answers. The first one on China is the general saying that the US can stay out of a recession if either China or Europe is out of a recession, but if both are, having a downturn, then the US will also have a downturn. But to more to the point of what you addressed, yes, whatever China does has a huge influence on liquidity, on the sentiment, on the stimulus. And so if China is in tightening mode, that will have an impact. And conversely, if they are in stimulus mode, that does have an impact as well. I'm not going to try to guess whether it's 70% or relative to some number or whatever it is, but we see it in the markets that when the policy changes. Now, the challenge, of course, that China has is that each one of their sectors have been under pressure, right? They pumped everything up with real estate. That didn't work so well. They pumped infrastructure up. That didn't work so well. And then the other area, of course, that they're pumping up is the industrial base. Well, if you have a command economy, we're talking on May 1st, so I may use that term freely, and that's Labor Day in many of these countries, celebrating communism. That will have capital misallocation, and the factory utilization in China is not very good, and so it is difficult to predict the demise of China as so many people have done, because they have resources. Now, they've also been increasing the gold reserves. It's still a small portion of the reserves, so they're not using up all the money they have. They're actually able to put something aside there, but yes, China does have a big impact. Now, on Japan, as we're talking just before we got on the call, here the yen moved up 2%. Almost certainly it was another intervention by the Bank of Japan. Let me first make a comment on that specifically. What intervention does, it's a disincentive to use leverage, because think about the yen. It's a funding currency. People borrow in yen to buy other things. When there's intervention, there's more volatility. That means the professional investor, for risk management purposes, has to reduce the exposure. And that in turn helps move the yen higher. Now, that's a technical explanation. The fundamental thing is, of course, they're not fixing any fundamentals in Japan, and they have a huge fiscal deficit, total deficit. And if rates were higher, how do you afford financing that deficit? And so that is a huge challenge. And the Chinese yuan and the Japanese yen are actually quite significantly correlated in that sense when there's an up move in the yen. And if I can look just on my other screen here, CNH, the offshore one, is up now about 0.3%. Earlier this week, it was up 0.4% in a day. The Chinese yuan is a managed currency. It doesn't move that much. So when the yen moves, it drags the Chinese currency with it.
Okay. And then, presumably high for longer means that the dollar is going to stay stronger for longer versus these other currencies.
I raise my eyebrows because I've been around the currency markets long enough that I try not to believe these generalities. Reality can prove you very wrong with these things. There are different currencies that have different dynamics. The yen somewhat decoupled because they have a quote unquote mess. Countries like Australia, New Zealand, I would think that may apply. These are countries with significant current account deficits. When they have a lot of growth and they have higher rates, those currencies are strong. But if you take the euro can be strong with miserable growth. And so there's always this thought that a currency is strong when the rates are higher. There is a relationship there, but I would not jump to that conclusion automatically.
Okay, so you're basically saying not enough data to tell.
I would discourage anybody to trade currencies based on our conversation. How's that?
Okay. All right, so I'm now going to switch to our user comments here, and folks, please continue to ask more here. And while I get started, too, folks, if you enjoy these live reaction videos to the Fed press conferences, and would like to see more of this type of format in the future, in immediate response to big developments, please let us know in the comment section below. All right, so I'm just reading the questions as asked by these viewers. Greg here asks, is Powell indicating that now is the time to go long U.S. risk assets? and then says that the 230 yield inverted yield curve is indicating the opposite. So that would be in contrast to that. What do you think?
Well, there's always a widowmaker somewhere, right? The further you go out on the yield curve, the more dynamics you're taking on, and there are more different things that drive that. And that's why I'd be just very, very reluctant. Just as we just talked about the currency market, right? You can be caught wrong-footed by just jumping to the conclusion, hey, the rates are higher for longer, therefore the dollar has to be strong, right? I mean, if I look on the screen today versus the G10, the dollar is down versus all currencies, right? We are higher for longer. Well, what does it mean, right? And part of that
sorry,
is
that down change? Is that down from the Fed announcement, or was that just the day's average?
That's the day's effort. If I hang on a second, from the Fed announcement, the dollar weakened, right? And that's really is because it's the signaling. I've mentioned this before, right? Imagine an inflation print comes in higher than expected in the country. Usually the reaction is that the currency rises. And the reason is that the market then expects that the central bank will be tighter. And that means the currency might be stronger. It's then over time, as reality sinks in and the central bank may not be tighter, that the currency weakens again. So that's why it's difficult to jump to these conclusions. On the rate side of things, right? In the shorter end of the yield curve, you can take positions, you can take it anywhere, right? But there's a huge market, mostly because banks are hedging their mortgage risk, where you can take speculative positions, and we don't recommend anybody does that. And people do that with huge amount of leverage, where you can bet on rates being lower or higher. But you can be wrong on this stuff, right? Higher for longer can be a huge curveball to that. Now, going out the yield curve, when you're long treasuries, at least you're harvesting the yield. When you're short treasuries, which many people often are, you better get your timing right? It's great to talk about these things, but somebody who has been in the market of actually investing or trading these things, you better know what you're doing, because otherwise you're pretty much giving away your money to others that facilitate your trades.
Okay. All right. We're going to have sort of another question in that same vein. From Neil here, what's the likelihood of a rise in 10-year bonds that could drive the Fed's hand and force them to reconsider raising interest rates over the balance of 2024? Well, I think as Powell was pretty clear, I don't think he's really considering raising interest rates.
Well, the question is whether his hands could be forced in any way or shape.
Yeah. So this is basically the bond vigilantes, right? A bull steepening of the curve.
It's the
or bear steepening.
The Fed is clearly concerned about the high mortgage rates clogging up the mortgage market, but it's not been the driving force in their action, right? The driving force is the job openings are leveling off, which means they have an easing bias. Otherwise, inflation is still high, therefore they're still higher for longer. At the other end of the spectrum, there's a potential crisis in the banking sector. Let's clean that up and let's buy enough time. And of course, they've given some deadlines to the small banks to get their act together. And part of that was that, hey, we'll lower rates to make your life easier. They can't promise that, and now the data are not playing along. So they may have to extend some of those lifelines they've given to the small institutions. And so it's kind of this cliff walk that they're trying to do to nudge the economy along. And so you asked this question earlier, right? Is this recession going to be stronger and whatnot? Is something bad going to happen? I remember many years ago, and I may have mentioned it in an interview with you a while ago, is that the Fed has a sledgehammer. Isn't bad stuff going to happen? And it was a former Fed official who was in the weeds, and he kind of shrugged it off and just talked about fine-tuning things, and the Fed will fix it. And that's kind of the attitude that they have. You take out the fire hose if there's a problem, right? And so whatever that may require, I mean, quoting Draghi, whatever it takes, right? It's a central bankers don't like to say that, but they will say it as necessary. And that's the famous Fed put, right? And whether the Fed's hands will be forced by the yields going too much up or down, I don't know. What we do know is that this economy has been holding up much better with the high rates that we've had. And so I think if anything, that's a disincentive for the Fed to act. I think they will act if they see something that's on fire. And of course, we could have another run on banks, and then they'll roll out a few new programs.
Okay, and I'm just curious, do you have an opinion right now on the stability of the banking system? When I was interviewing Dr. Honig, he used to basically, it was a director at the FDIC, so he knows bank risk. And I asked him to rate where he thought we are on the risk scale, with 1 being very calm and 5 being, a crisis. And he put us at like a 4 out of 5. I mean, he said, I'm very concerned about the state of the banking system right now. But I'm curious your thoughts.
Well, I mean, the banking system in any country is a political bargain, right? And in the US, we over time have had a gazillion of bank failures. And it is because we got this artificial construct where we're protecting the small banks because we don't want the bad big banks to take over everything. It was really local politics, right? You have these, if you think about it, there was small banks helping the farmers, and there was a disincentive by the farmers that these banks would run away and give others credit, because even during bad times, they wanted these banks to serve these farmers. And rather than them having to spreading the risk and then saying, hey, lending money to farmers is not worth it to us. And so the system was created where you have these thousands of small banks that really should be merging into larger ones to diversify their risk. And then we're piling lots of regulations on top of them so that they can't see the forest from the trees, and then they mismanage interest rate risk and they lend commercial real estate locally and do all kinds of stuff that comes back to bite them. But then when there's a problem, the Federal Reserve comes to the rescue. And in some way, and by the way, talked about FDIC, right? It is the FDIC that got a mandate. First, Bill Clinton with his third way, that in order to help the poor, we give them credit, right? You don't have any money, we give you a credit card. That helped the economy a little bit, right? And I'm not trying to be political. It was the Bush administration, second Bush administration, that forced the FDIC to lower credit standards. And then in addition to that, the FDIC was, that's the Fannie and Freddie, not the FDIC, of course. Fannie and Freddie were lowering. They were forced to lower credit standards, and the GSEs, Fannie and Freddie, they didn't publish financial statements then, and so the central bank couldn't see the latent risk that was blowing up and building up in these uber leveraged institutions that blew up the financial system. The post-financial crisis report then blamed the bad bankers, but the folks who take the real blame are the politicians that set up the Ponzi scheme called Fannie and Freddie in the 1930s that took 80 years to blow up, right? And so we have this fairly fragile system. It's fragile by design. And then we have a central bank that has a bazooka, and there is no political will to fix it. So is there fragility? Yes. Is there fragility like we've had in 2008? No, in part because we know that the tools come out readily whenever there's a little concern somewhere.
So looking forward then, Axel, are you net optimistic or net pessimistic about just sort of the economic and financial system that we have? Because there's a lot of things that we can point to, like Social Security, is a good one. Like, it's the folks that run it have said that, hey, that fund is basically going to, start becoming insolvent. And I can't remember the exact date, but it's in the 2030s somewhere, I think, if I'm not mistaken. We have lots of unfunded entitlement. I mean, there's just a lot of things where there's no political will to roll up our sleeves and really tackle the big problems. It's just, what can we do today to make everybody feel good enough today, and then push it off to the future, and hopefully somebody else will figure it out.
I think you just gave the answer, right? I mean, because define positive, optimist, or pessimist. I don't even know how to answer the question. We know that there are issues. We also know that the only motivation that politicians listen to is market forces. right? Look at Greece. They got their act together when the market forced them to do it. I don't see any political will to properly reform Social Security. And by the way, the entire system we have is geared towards helping the elderly. The elderly have more savings than ever. They're very well off in a historic context. And so, but politically, we need to give them more and more money. I'm not so sure whether the young voters are like that now. Oh, there are lots of old people, right? So they're voting for themselves. There are lots of reasons why the system should be reformed, and why certain people probably shouldn't need to get government handouts in their old age. But try changing that, right? Try in a democratic process to try to change that system, and it's not going to happen. And so what will happen is, yes, it will probably run out of money, and then there will be some last minute patches. And the problem when you're out of fiscal discipline is that you tend to veer towards more populist politicians that promise easy fixes that don't exist, and that just increases the instability, right? Look at Turkey, and so it's a. Am I an optimist or pessimist? Well, I'm a realist, I suppose, right? And the all we can do is, as individuals, we can get engaged if we're so inclined, or otherwise prepare in our investment portfolio otherwise.
Okay. On that vein, I'm going to pull up Neil's other question here, which is, I think you might have already answered the dollar part, but feel free to expound on it if you want. But given high for even longer reduction in QT, what impact do you think it's going to have on the dollar and on precious metals?
Well, QT, I'm shrugging off somehow, because I've never really liked QE. I never really liked QT. QT matters when they tighten too much. They have learned their lesson, and so it's part of the reason why they're reducing the monthly amounts. They're reducing the balance sheet by. The problem they have is that they have conflicting regulatory schemes for different types of institutions, and so the Fed doesn't know where the pain threshold is for the market. But this is more kind of the micromanagement side that has some implications, but it's something they'll quote unquote address, right? The higher for longer part of it is, well, the Fed is reacting to what the market is doing, right? There wasn't anything brilliant new coming out of the Fed today. So the fact that inflation hasn't coming down in earnest is not news to the market. That's been building over recent months, right? Because the Fed is the bazooka, the market is still listening to the speech whether Powell changed his mind. But the only thing we got there is, hey, we got a confirmation that he has an easing bias, but the data don't allow him to ease yet. And so, since you mentioned precious metals here, precious metals and the mining companies have started to take a bid ever since last October, when Powell had what I would call his mission accomplished speech. Some people put that more into December. I pinpoint October. It's the bias that matters to the market. It's not the movement that markets. If the Fed were to lower rates, the market would focus forward. Well, when are they at the bottom? When are they going to hike again? Whereas, as far as the metals are concerned, it is that bias that got reconfirmed today, and so the gold miners today, had a decent day, right? And so it's in that context that we have to look forward of what might happen, and I don't think there's been a huge change. The higher for longer, as it hurt risk assets and precious metals and gold miners, was that, hey, we're not tight enough. We might not be hiking rates, but we're not even thinking about lowering rates, right? That sort of environment, even if it's exactly the same rate, that difference in attitude makes a difference in a market that's forward looking. Because in one scenario, the forward looking path is the same or higher, and the other one is the same or lower. Now, that said, of course, in the long run, the market will always pricing easing, because it has to price in the risk of an unknown, and that risk will increase over time. But still, this shift in sentiment, I think, matters much more than where rates actually are.
All right. And I guess shift in sentiment. I just recorded an interview yesterday with Peter Atwater, the behavioral economist who, like, sentiment is the pillar of what he bases his analysis on. Has like where would you peg market sentiment right now? Because I mean, Powell didn't surprise anybody today, like you said, right? I mean, the market recently has had to say, okay, we're not getting the juicy rate cuts that we were hoping for. That's already kind of largely priced in here. But stocks are still at 5,000 on the S&P. We're still near all-time highs. Do you? I guess, did anything happen today that you think is going to materially impact sentiment going forward or not?
Well, the initial reaction was, "Hey, Goldilocks is back," right? And by the time the S&P closed, as we're talking today, at least the futures are negative. The Dow is positive. Here we go.
Okay. Sorry to interrupt though, but is Goldilocks back? Because of course this week everything we've been hearing is well, we were hearing reflation, but now we're hearing stagflation, right? And to the point where Powell had to say, "Hey, I'm looking at the data here. I'm not seeing the stag or the inflation." But that does seem to be the new narrative, right?
Yes. Well, the glass, when people are optimistic, right, that usually is a turning point. But then again, the bears have thrown in the towel, right, many times. And when that happens, maybe it's finally time for the market to turn. I mean, I continue to be concerned about the quote unquote Mac 7. Now, the Mac 7 is really more of a Mac 6, 5, 4, whatever it is, right? Um, but there's clearly a lot of money being pumped on and into cloud services to help facilitate all this wonderful AI data crunching that will need to take place. And there are a few select players, at least so far, that get the bulk of the benefit of that. Um, to me, it goes back to the consumer. The consumer is getting weaker. I am cautious um, about the outlook in the S&P. But then again, right, we manage over $1 billion in gold mining, so call me biased, right? Because our portfolio tends to perform better when the market does worse. I did have a discussion with my wife about portfolio allocation. I told my wife I can't give her specific investment advice as a good investment professional. Now the question is, hey, there's some money we allocate sometimes to index funds and whatnot. And I said, well, do whatever you like, right? I am not that optimistic, but historically speaking, right? If you're not in a recession over the medium term, the S&P does well. So I'm not going to talk anybody, not even my wife, out of allocating money in that segment if we're not smack in a recession.
Yep.
Does that mean I wouldn't say that there are significant warning signs? Yes, I don't like it when you have a few stocks dictate the market. You have a consumer getting weaker. You have a Fed that wants this economy to slow down. There's a saying, "Don't fight the Fed," and so I get out of the way when the Fed wants to tighten. Does it mean the market can't go up? Sure, but my goal in life is not to beat the S&P 500, but to have a sustainable investment.
All right. Well, look, we'll wind it up here, folks. Last call with questions. I've got one or two more things to talk with Axel about, and if anyone wants to slip one in, feel free to try there. To your point about the consumer, I've watched a number of these, these press conferences with Fed Chair Powell, and there were definitely some pretty pointed questions today about the pain that consumers are feeling. And Powell, a couple of times really went out of his way to say, "Hey, we get it. We know that inflation is terrible for everybody, but it hurts the weakest households the most, and that's why we're just doing everything we can to try to get it down." And part of me wonders how genuine that is. But he made a comment that I thought was pretty tone deaf. He said, the process of getting it down, yeah, it might be painful, it might be inconvenient, for these higher rates and whatnot. But then he said, but then we'll get down to 2% and you won't have to worry about inflation again. Kind of glossing over the fact that, like, people's cost of living just went up by like 25% in the past 4 years. It's like, that's not getting walked back, right?
No, and he was even praising his board that not everybody is a PhD economist. Well, he isn't a PhD economist. He's a lawyer. So you give him credit for not being a PhD economist, but then you
Yeah.
take points off for him being a lawyer. So it's a lose-lose for him no matter what. But yes, I mean, that's of course the crux, right? We don't go back to the old price level. And it is, if you actually need to work for a living, it sucks, right? I think that's the technical term.
Sorry to interrupt, but it's like chopping somebody's, one of their limbs off and then putting the sword away and say, oh, you don't have to worry about it anymore. I put the sword away. And it's like,
well,
right, but I'm like missing an arm.
that's of course part of the problem, right? The monetary policy can be mediocre when fiscal policy is good, but when fiscal policy is bad, even good monetary policy doesn't help. And the reason I say that is there are some unstable dynamics that got unleashed here, right?
Mm-hmm.
And the anger that you're at least touching on, right, is real. And so that will impact the voting behavior of people. And I'm not trying to take sides here for either one of those two blokes that are up for election, but it rather than focusing on I guess few elections ever focus on important issues, except for the various cases, right? But rather than letting folks conduct good fiscal policy and good monetary policy, you get these curveballs that you're inviting because you mess things up so much, and so there's an anger that's developing. I mentioned Bush earlier for having put pressure on Fannie and Freddie. Well, it was more than that, right? It was remember the Keep America Rolling after 9/11. Well, that was just as China came on the world stage. Remember, China didn't always used to be as big as they are.
Right.
And so they dumped the goods on the world market. In addition, we provided a stimulus in the US. And so the result was that the market was flooded with goods, inflation was low, so the Fed was quote unquote happy. Companies had to deal with these cheap imports, so they reduced their variable cost. The cost that they could reduce was the labor, which means they outsourced more jobs over to Asia. Because we have such a flexible economy, these guys and people have so much debt, they found new jobs. So the economy worked, but it was gut-wrenching. And then sure enough, a few years later, a populist comes to office, right? And so it's dynamics that are long in the works in having that happen. And I highlight this, right? Before I mentioned Clinton, almost every politician has done stuff like that. It is rare that you have somebody actually take a step back and just do what's right in the long term, because that's not how politicians are wired.
It's not, and sadly, it's not how we, the populace, it's not the message we want to hear, right? In other words, we don't want to have to take the sacrifices today to enable a leader to,
and
make
politicians are a reflection of the public, of course, right? I mean, we can complain about Washington, but hey, yeah, who got them there? And so it's none of that is terribly surprising. What I can say is Paul Volcker, he said, in order to have a stable government, and you need to have the fiscal house in order, you have the monetary house in order, and you need to have good governance. You have to have stable institutions. And he was more of a big government guy than I'm comfortable with, but he's right on those issues, right? And we have eroded all three of those, and that just creates a dynamic of its own that creates a very unstable dynamic.
Agreed, and we'll leave it here. I will say, with the preponderance of folks that I have interviewed who, have knowledge of the actual inner workings of the system, Honig being right near the top of that list, they give us the worst marks on the fiscal side of things right now. That seems to be the element that is the most out of control right now. All right. So as we wrap up here, a couple questions for you, the audience, and one or two last questions for you, Axel. Audience, if again, let me know whether you're watching this live or watching this on the replay. If you like this format of these kind of real-time reaction discussions to notable macro developments that are going on in the world. We've been doing these ones in Axel and I in response to Jerome Powell's press conferences and the Fed releases. I did one a few weeks ago with a geopolitical analyst following the outbreak of hostilities between Israel and Iran. If you'd like me to try to do more of these when important things are going on in the world, let me know in the comment section. And let's see, Axel, please let folks know if they want to go follow you in your work, where should they go?
Well, I think it's down there at Axel Merk on Twitter is
That's on
the
Twitter,
best
right?
place. Yes, that's on Twitter that you can follow me. Now, I can't talk about what we do at Merk Investments there, just talk more generally. So
But
if you
I'm
want to
putting up
see
your
what we
URL
do,
right there.
there we go, at Merk Investments. We have a newsletter there. Please do sign up there. There's a link to what we do. We manage about 1.3 billion in gold and gold mining. We used to do much more, by the way, in other areas, but whenever we do that, we get drawn back to precious metals. So it's
When you're good at what you do, they just keep pulling you back in, brother.
something like that. But yes, come and follow our work.
Okay, great. Speaking of following work, just want to let you folks know who's coming up soon on the channel. This weekend, we've got Michael Every on Sunday. On Tuesday, we've got David Rosenberg. I think the following Thursday, we've got Peter Atwater. That's when that interview will release. And then the following Sunday, I know folks will be thrilled to hear Stephanie Pomboy will be on the channel. So we've got kind of a murderer's row coming up here following the high bar that Axel has set. Folks, if you've enjoyed this, please, as always, hit the like button and click the red subscribe button below if you haven't subscribed to this channel yet, as well as that little bell icon right next to it. That bell icon lets you get alerted every time we have a new video here on YouTube. And then just want to remind folks too, for all things me and Thoughtful Money, just go to thoughtfulmoney.com. If you're watching this on the replay and you'd like to be part of the crew that gets to watch these experiences live and ask questions, again, that's available to our premium newsletter subscribers. Just go to thoughtfulmoney.com, click the newsletter link. You can sign up for the free newsletter there if you're not already subscribed to it. And then once you do, you can always upgrade to get all the benefits of subscription, which includes, interactive events like this, but also the new, my Adam's notes summaries to all the interviews, but also the new Macro Pass service. And folks, premium folks that are watching live right now, let us know in the comments how you're enjoying the Macro Pass service, if you think that was a good addition. And with that being said, Axel, hope we get to bring you willing to come back on and do this again at the next Fed meeting. I think it's in June.
Yes, I mean, the good news is Powell doesn't listen to me, so he'll do another press conference and we can talk about him again.
All right, great. Well, I look forward to seeing that, Axel, and everybody else. Thanks so much for watching.